I'm going to get. Oh. So, thank you everyone for listening in today. My name is Ryan Staton. I am one of the managing partners here at StatonWalsh. So, for those of you that are new to some of our market updates, we do these quarterly. Uh, Typically about what's happened in the previous quarter, a little bit more of an update on what's to come. This is a particularly interesting year. We'll talk a little bit about what's happened, what can be anticipated moving forward, and then we will touch on some outlook items and just some tips and some other things to look out for as we get a little later into 2024 and then turning over the calendar to 25. So my agenda for today, pretty simple. We want to review the first half and just talk about what happened in the US market specifically. The second half, talk a little bit about market forces and things that are affecting markets and will affect second half outlook. Take stock of kind of where we are now. This is through the lens of more of a macroeconomic view, looking at what data has come in after the end of the second quarter and how we're going to apply that on a go forward basis. And then really what's ahead for the second half of 2024. So let's review what happened first half of the year in markets. And so the typical measure that we see with U.S. markets, we look at the S&P 500 as an example. And so you'll see throughout the calendar year different news items there. CPI increased at the start of the year to 3.4%. In March, the Federal Reserve indicated that there may be some rate cuts possible at the end of the year. Q1 GDP growth comes out in April, and in May, we see that core inflation has slowed to its lowest increase in 3 years. So, um, with all those things happening, you could see that the market has moved in different directions, and um, really a big part of the first half was marked by three major themes. I think AI enthusiasm, which we're going to talk a little bit about later in this session, fears around inflation, and then ultimately, what's the Federal Reserve going to do? What are they signaling? What do they think is going to happen? Interest rates are a big topic of conversation. I feel like the most of what we've done over the past couple of years with these presentations has really heavily centered around inflation and interest rates. Some of that remains the same, but there's also some other things that we're waiting to see in the latter half of the year. Um, During the first half of the year, you would have heard terms like Goldilocks economy, which basically means that activity was moving forward at a not too hot pace, but not too cold. And so kind of middle of the road of like there's been some progression and some movement in the economy in a positive way, but we're not blowing the doors off and we're not heading in the opposite direction at this point. And so the market has kind of reflected that and really given this feeling of almost like status quo throughout the first part of the year. And so we're going to talk a little bit about that and unpack a little bit more about, what's happened in other parts of the market as well. So if we zoom out, not just the S&P 500, but if we look at quarterly performance for the major indices, so the Dow Jones Industrial Index, S&P 500, and the Nasdaq in the US, and then internationally emerging markets, a broader all world index, and then MSCI EAFE, which is more of an indication of developed markets. So countries in Europe, for example, and other developed economies. And so what you'll see is that a big driver of growth over the last quarter and really indicating what's happened this year, the NASDAQ composite, which is pretty heavily made up of technology companies. We've seen a reemergence of growth in 2024 in a big way and heavily driven in some cases by a short list of companies. But nonetheless, that's where a large part of the performance that's been seen over the last quarter and year to date has heavily leaned towards technology and information technology sector. So over the past quarter, this is what we saw as of June 30th. If you've checked the market recently, especially in the past 30 days, there's been a little bit of a reversal in some of this. Tech stocks took a decent hit in parts of July. and there's been some bouncing around in that part of the world, in that sector. And we'll talk a little bit about some of the reasons why that's happened and how to continue to monitor those things as time as goes on through the end of this year. When we talk about the rest of the world and global markets, so emerging markets was the strongest performer in the last quarter. Traditionally, an asset class that has not done well in really, you could argue maybe even the past decade in terms of overall performance, but there are other parts of the world in comparison to the U.S. have not performed in the same way, but are showing signs of life and reemerging in overall performance when we talk about the short term, at least in recent history. So, um, transitioning back to asset classes, and when we look at US versus the world and other things, as I mentioned, technology companies, which primarily are categorized as US growth stocks, have been a big driver of growth this year. So year to date, the technology, or not just the technology sector, excuse me, um, the US growth asset class is up just under 21% as of the end of the second quarter. The S&P 500 during that same time period, 15.3. You can see some growth in commodities, emerging markets, US value. Asset classes that were negative or flat, municipal bonds, aggregate bonds, US treasuries, and real estate. The bond market, and I'll talk about this in more detail in a later slide, but the bond market has had a pretty decent struggle with the higher rate environment, specifically how rates are positioned when we talk about bond durations and other items. But that has been a heavy point of focus and a large reason why there's been some underperformance in that sector of the market. When we look out and we look historically over the past 10 years, you can see growth has been a pretty strong driver. Um, Followed by the S&P 500. The S&P 500, by the way, is a blend of growth and value. It's kind of a middle road between the two, and is categorized as such, and that's why you'll see the straddling of growth, S&P, value throughout the chart. You can also see that historically speaking, over the last 10 years, commodities had not been a particularly strong performer. We're starting to see a reemergence of commodities, especially in recent years, um, primarily as a result of rising prices in that sector, um, and use of different goods and services as well. So, broader gains in U.S. equities overall, but you could see some heavy tilts in very specific asset classes as of late. If you sat in on some of the previous presentations or you watch any financial news, you no doubt have heard the phrase "Magnificent Seven." So, what does that mean? The Magnificent Seven is based on seven stocks that are part of the S&P 500, primarily technology driven, but are driving a major part of the growth in some of the indexes between the Nasdaq Composite and the S&P 500. And so you'll see here year to date, as of the middle of July, actually, you could see how these companies have performed. And so the S&P 500 as of July 11th of 2024 was up about 14, just under 14.5%. Some of these individual companies are up considerably more in many cases. And so, what does all this mean? The index pricing, which is really what a lot of financial media networks pay attention to, what most investors pay attention to, the performance of these indexes have been heavily driven by a very short list of companies. And so we see companies like Nvidia year to date up over 150%, Amazon 27, Google, Alphabet or Google 30, Meta 42, and so on. So the one exception to that has been Tesla, which actually year to date is down double digits and down over 20, just over 20%. Um, these companies have been a driving force in recent years and been a driving force in overall performance. And I think it's important to really understand what role they play in overall index performance and how we kind of gauge where is the market as a whole and where are companies and the economy as a whole in relationship to what the performance of the major market indices are. Another thing to pay attention to is, and many folks buy various indexes, large cap growth, S&P 500 indexes, and different types of accounts. Understanding what's under the hood and what things are owned and how they're weighted is another consideration here that I think is pretty important. And so the idea behind this is there's been a um, pretty heavy push from these seven companies in terms of performance in the market as a whole, and certainly something to pay closer attention to as the economy changes, as the interest rate environment changes, and as the revenue models and profitability and such of these companies start to come out later on in the year. That will be important. Another heavy piece of this is AI, which has been a big driving force and some optimism and some bullishness in the market, and how some of these companies are starting to participate in that space. So let's back up a second and just talk about what some of the price targets were for 2023 and 2024. Um, so a lot of these firms have analyst teams, and they come out periodically and they say, at the end of 2023, I'm going to look at what I think the price of the S&P 500 is, measured um, in the values that they look at there in terms of price value. Um, and each one kind of makes a guess, and they say, this is what we think will happen next year in 2024. And so, as you could see, the group average was about 4,800. As of May 31st, the S&P 500 closed at 5277. As of today, it's up a little bit more and is right around just above 5,400. And so, as you could see, forecasts are all based on assumptions. They get revised over time. But most of these major institutions had a feeling that the S&P would potentially grow at some rate, but some estimates or assumptions or forecasts were a little bit more moderate in nature or modest. Some felt like that the index was going to go backwards and 2024 would be a down year. Um, Really, sorry, let's go back here for a second. The purpose of looking at these types of things is to understand what folks are looking at. But also, really, it kind of portrays the fact that in many cases, when you look at the data and what's happening and what you feel is on the horizon, at least from these companies and these analysts and research teams, they had different indications of what they thought was going to happen. That's obviously played out in a significantly different way. Um, and so, these years like this and predicting what's going to happen can be particularly challenging, especially when you talk about the environment that we're in. And I think that's an important emphasis, is that there's tons of uncertainty about what's going to happen with inflation. What's the outlook on global economic growth? What are central banks going to do around interest rates? And so when these predictions are made at the beginning of the year, all of those things are relative uncertainties that you really can't understand until you get there. And so I always include this kind of at a halfway point and a recap of the total year to really emphasize the fact that these are predictions. No one can actually predict with 100% accuracy what's going to happen. And these are groups of really, really, really smart people, some much smarter than I am. But it is almost impossible to look at this at face value and get it right. And so, what does that mean moving forward? That means that there's going to be some emphasis around creating opportunities in the investment world, particularly around discipline, structure, keeping consistency in the way that you're going to look at that, and the way that you're going to participate in the markets as a whole. So, shifting gears and really getting into second half outlooks and just talking a little bit about market forces. So this chart is from City National Bank, City National Rockdale. They do a really good job with this economic dashboard and kind of showing what things will have a positive impact on investment, what things they view are neutral and which are negative. Forecasts usually are built on a 3 to 6 month time horizon. And so if we look back at the beginning of 2022, with which, if you remember, was a pretty from an S&P 500 or US markets perspective, relatively painful with market losses, increases in interest rates, inflation. There was a lot happening over that time. And so when we started the year, the economic indicators looked relatively positive. The big net neutral items were, what's the political environment? Are equities overvalued? And then what's the geopolitical risk on the horizon? And so this was a relatively optimistic point of view from what we could see. And we transition to January 2024, and we see not necessarily a reversal, but a pullback in some of the viewpoints on different economic indicators. So pretty much neutral across the board, with the exception of international economic outlook is something that gets a large amount of attention. We sometimes get heavily or hyper focused on U.S. markets and what goes on there because that's where we live, and that's where a lot of investment happens for our clients and for other folks that are participating in the markets. But international economic outlook is important. We are a global economy at this point. We do rely on resources and goods from other places. And so the ability from a global perspective to grow economic activity will be, very important over the long term. And so that was something that was viewed as potential negative. Geopolitical risk. Obviously, there's a lot going on in the world that still continues today. And so what effect will that have on markets? And how will that kind of play out over the next 6, 12, and 18 months? And then equity market valuation still kind of something that gets a lot of attention. Primarily, we're seeing huge run-ups in tech stocks. We're seeing valuations that are kind of outside the norms. And so naturally, that does raise the question of like, can this continue, and what does that look like over the long term? So fast forward to June. So what's happened? We've seen some positive movement in Q2 and the first half of the year, where we're seeing some upswings in these economic indicators. So now roughly one third of them are positive. Really, the only two negative are still equity market valuation and geopolitical risk. Everything else is relatively net neutral with some positive views, primarily because of economic data that's starting to come out, and we're seeing the progression throughout the year. Consumer sentiment is up. The spending is ticking up a little bit. Corporate profit, relatively positive, not for all, but just when we look at a macro trend. Labor markets looking a little bit more positive. So there's a lot of things to be potentially excited about. But you could see that even in a short period of time, there's been some shifts in sentiment and outlook and where research teams feel the economy is ultimately headed. So let's talk about where we are now. Potential headlines. So if you're paying attention to any news, the biggest headlines related to market, the market will be, will the Feds cut rates? Is this a soft landing for the Goldilocks economy? Did we actually achieve that? There's more indication that may actually be possible or may already be happening. And then the other big piece is AI and the expansion of AI in the tools that we're using and the things that we're doing on a day-to-day basis. The corporate world has seemed to really embrace the idea of that. And so there's a ton of growth in that space. And ultimately that leads to potential growth for some of the corporations that participate in it, in the tools and resources that they sell. So these are things that are of concern or reasons for optimism for some, and some things that we're going to see in the news cycle for the remainder of the year that ultimately will help be a driving force for market outlook and performance potentially. So let's talk about inflation and wage growth. This is a big one. It's one that constantly gets talked about. I am not naive. We are in the middle of an election cycle, so you will probably hear more about this than a lot of other things over the next few months as campaigning and debating potentially happens. But here are the numbers. As of today, U.S. inflation rate is just under 3%, with a core inflation rate of just over 3.25%. We have seen wage growth in terms of overall earnings year over year. Um, you see that their hourly earnings in wage growth on that top line, that purple line on the right-hand side, and then that blue line is the real average of hourly earnings, primarily driven by an inflation adjusted calculation. So we're seeing average earnings for individuals go up year over year um, at a rate of currently about 3.86%. But the real average adjusted is just under 1%. And so what we've seen over the past several years is an increase in wage growth, primarily driven by a large increase in inflation. And so the real net, we are positive, which is good. You could see between 2020 and 2022, real wage growth and real hourly earnings were actually negative on that bottom chart on the right-hand corner. So we have cracked beyond even. But this is something that is ultimately a concern for individuals and something that I tend to focus on in a different way. I think that top line inflation, and when you look at what is put out there in financial media sometimes can give a skewed vision of what's reality for some of us. I use this example all the time, but my rate of inflation is probably very different than any of yours and the next person. So if you're someone that drives a great distance to work every day and price of oil and gas is up significantly, your rate of inflation is much larger than someone who is working completely virtually. Or we were just talking about this morning. The price of groceries in my household is absurd. I have small children that just eat fruit like it's going out of style. I may need to just open my own farm here at some point, but the point being that the rate of inflation that we experience as consumers is directly related to how we spend money and how we spend our time. And so these numbers look relatively positive. That all that said, it may not feel that way for you. And so the data says that inflation, in terms of the growth of inflation, is down, um, relatively speaking, but that may or may not be the case for some of you out there that are listening and based on how you're spending your money as of late. So the big point of emphasis is we are seeing some growth, but we're also seeing inflation. And so the real goal economically is maintaining pace so that we don't fall behind where we have a rate of inflation wages that can't keep up with that. That ultimately does not indicate a positive tailwind for economic growth in most cases. Transitioning that to employment. So we have job openings versus US unemployment rate. You could see there was a peak of job openings. There's a lot of charts here on the page. I'll just kind of take a step back and just talk about this generally. The state of employment today in reality is that unemployment is relatively low. It's ticked up slightly recently. It was at a low of about 3.4%, at the time of completing this in a couple weeks ago, mid-July, it was up to about 4.1. You're also seeing total non-farm job openings of about 8.1 million. Um, the big thing is labor force participation. So the participation rate is still below pre-COVID levels, and it's incremental percentages. But when we talk about a population of the size of the United States, those incremental percentages they really do matter. And so low level of layoffs and percentages. We have some job turnover happening in the economy. We saw a lot in past years just because inflated salaries and heavy competition, especially in the technology sector. But the big point of emphasis here is unemployment rate is low, and that is certainly a good thing. The challenge that we are facing, and I think partially the transition to AI and some other technology, is that there are many job openings that companies are not able to fill currently, partially because of labor force participation, but partially because people are transitioning and we're becoming more heavily focused and being a service-based economy. And so, places like manufacturing and other types of jobs, and construction and others that we see, they're having a hard time attracting and competing for talent. And so it will be interesting to see in the near future how companies adapt to that. AI cannot fix everything, obviously. AI can't swing a hammer. So that is a problem that will have to be solved in other ways. But this is something that is getting a great bit of attention because there are a large amount of openings and not as many folks still participating in the labor force. And we do have a generation that's currently retiring in pretty large waves every single day with baby boomers. And so that transition to the next generation, what that looks like. And so really a lot to unpack here. And a lot to pay attention to as time goes on in terms of how we adapt in terms of what unemployment looks like, how these jobs get filled, and how we progress in that space. GDP and public debt. So GDP growth has been as of Q1 of 2024, US GDP was just over 27 or 28 trillion, excuse me. Real US GDP, just under 23 trillion. That changed from Q3 to Q4 of last year. It was about 4.5%, which is pretty significant given the projected headwinds in the economy. And there's been a lot of opinions about what will happen, and we talked about some of those projections and what's going to happen with corporate earnings, and a lot of that stuff hasn't come to fruition, which is why many are leaning towards this idea of maybe the Federal Reserve just happened to figure out that soft landing conversation for the economy. But the bigger point of concern, as we've seen some of the cash that was introduced in the economy with some of the COVID stimulus and other things, as we start to see that savings dry up, we are seeing a pretty significant increase in public debt. Public debt, especially in a higher interest rate environment, can become particularly challenging for households, which ultimately could be a crunch on cash flow and lead to less spending. And so that's really why all of this is important. We have seen a pretty significant uptick in public debt and the percentage of such in GDP. Not surprising in the early 2000s and beyond, just because of the low interest rate environment, having debt, especially low interest rate debt with mortgages, buying cars, like that was a pretty big driver for economic activity. But as we creep further into this prolonged higher interest rate environment, compared to what it's been the past decade, that's something that to pay particular attention to. If those numbers still increase at that rate and rates don't start to come down, there may be a bit of a cash crunch as some of those savings that are tracked start to dry up a little bit. I can't talk about interest rates and the economy without talking about housing data. Anyone who is trying to buy a house right now probably understands what's going on in terms of interest rates and prices. But relatively speaking, rates have remained, I would say, stable at a between 6 and 7% rate. They've fluctuated up and down periodically, but as of the date of this chart a couple weeks ago, 30-year rate was 6.86%. The 15 rate was 6.16. So 6.86 on the 30, 6.16 on the 15. Mortgage rate or mortgage originations and refinances have been down pretty significantly since kind of their peak in 2020 and 2021. No surprise there with higher rates. A lot of people bought or refinanced into lower rate mortgages. And so not as much activity there. Um, Generally speaking, in terms of like the market and what the outlook has been, um, the anticipation is really centered around what's going to happen later this year with the Federal Reserve and potential rate cuts. Ultimately, that's going to drive additional activity potentially in this market. We're seeing that sentiment is a little bit down, traffic is a little bit down, or significantly down, I should say, from its peak in like 2021 and 2022. Um, so, certain relationships between new builds and existing homes has been interesting as well. And the next chart actually gets into pricing for those, which I found this to be interesting for me, at least, that the median sales price for new homes sold, new houses, versus the median existing home sale price, um, were like pretty close. In fact, the existing home median sales price is actually higher. So, new single family houses sold versus US existing, there's a lot more activity in the new build space in terms of sales. Um, but there's a pretty heavy push in existing home sales, challenges with inventory, rates are still a little bit higher. What happens with all that? Um, it seems to be that values, even in this sustained higher rate environment, values have not decreased and have not gone down. And I don't think there's any specific view that that will happen in any significant way. And so if someone's trying to buy a house right now, the best piece of advice that we can give is, um, you know, obviously work through the financing piece and figure out what's attainable and what's possible. But it is definitely a tougher time to purchase a home. And it will be relatively more expensive than some of your peers that are, even your next door neighbors in the same house. Uh, and so that doesn't appear based on the data that we receive and that we've heard that that's going to change in any significant way anytime soon. And so rates still anticipated to be a little bit higher than they've been in recent years. And then in terms of availability of inventory, seem to be contingent on what the environment is on rates and who's going to ultimately be selling a home and then buying another home. So I think there's still a pretty large contingent that's I don't want to say stuck, but they're in a mortgage that's much cheaper. They may have a need to move, but they're choosing not to because of what the current environment is. All right. So let's talk a second about consumers and where consumers stand today. So when we talk about consumers, a couple data points that we look at, personal savings rates, you could see that the peak of that was 8.6%. No surprise, that was right at the timing of that was right in the middle of COVID stimulus. There's a lot of cash in the economy. There was a surplus for many folks. People who traditionally commuted to work weren't doing that anymore. There wasn't in terms of lifestyle activities, wasn't very much you could do in the midst of certain lockdowns and certain periods of time. And so we saw a pretty sharp increase in overall personal savings rates. That's since come down. um, the long-term average has been about 8.6%. Right now, that's about 3.8, which, we think could be attributed to higher rate environment, more costly goods and services, the rate of inflation. People are really just trying to stretch a dollar to pay for things that have become significantly more expensive than they are traditionally. And so as a result, they've pulled back on some of their personal savings that they're doing. And being a financial planning firm, that's obviously something that's of concern to us, and a point that we try to emphasize when we talk about these things is, trying to figure out cash flow is one of the hardest things to plan around, and especially when you're living in specific economic conditions like we have right now, with higher price of goods and services, kind of flat wage growth, and then um, higher costs, especially if you're making major purchases like vehicles, homes, etc. Those are higher payments as well. So that gets into this consumer credit outstanding conversation as well. So historically, the highest it's ever been. We are in an economy where a lot of things are purchased on credit. We've transitioned to almost, I mean, in many cases, I would argue a not fully electronic exchange of goods and services, but that's kind of where we're at today. I mean, most people are paying for things with credit cards, debit cards, etc. There's not a lot of cash exchanging hands anymore, which has also been a big driver of running up consumer credit. Um, the ability to pay that becomes a particular concern if we do have a situation where where folks are in a cash crunch. So consumers have more debt or more outstanding credit than they traditionally have. They're saving a little bit less. Retail sales are not, they're right around their long-term averages. So nothing of concern there. Obviously, we saw a huge spike again 2020, 2021, and 2022. That has started to dial back primarily because some of that excess cash that was pumped into the economy is starting to dry up a little bit. Um, Overall, consumer sentiment though is down. People are not they're what I would say a little more bearish on spending. And that reflects right everything that's happening in the right hand chart reflects in the left in that people are saving less money. They're spending more for things, and so that ultimately drives sentiment down. And you could see here that those upticks and downswings have correlated with recessions over history. That's not something that's happening right now, but I think this is a good indication that while things are still relatively positive from an economic perspective, they just don't certainly feel that way. So let's go into all right. Now we've talked about all the economic data. I've given you a bunch of charts, and I promise there's not a ton more. But let's just talk a little bit about what to look for in the second half of the year. I I put this chart up because one, I was fascinated that anyone even tracks this to begin with. I'm wondering if it's even a piece of AI technology that figured this out, going back through old calls. But um, Say AI. So artificial intelligence mentions on quarterly earnings calls over the past 10 years. You could see in recent history that spiked pretty significantly. So this is tracking all of the S&P 500 companies that are having conversations about AI. And so what this is telling us is that in Q4 of 2023, I think it worked out it was 179 times um that AI was mentioned on these earning calls. And so this is something that companies are really emphasizing, talking about what investments they're making in it, how they're using it, how it's going to affect their business model, and also just they know that investors want to hear that they're adopting and using the newest and greatest technology that's out there. And so everyone's using it a little differently, but I thought it was kind of fascinating in general that someone even took the time to track this going back to 2014. So AI is a big center of focus. It's going to be a big center of focus in a lot of companies, but primarily its use in their business models will ultimately, potentially help drive earnings and performance in some of the S&P's largest companies. So let's take a peek at 2025, look at GDP, unemployment, and inflation. So this is from the Federal Reserve of Philadelphia. So this is asking some of the folks that are part of professional forecasters that are surveyed as part of the Federal Reserve's research to figure out what do we think is going to happen. And so the taller bars are representative of the higher probability based on what the forecasters have put together. And so the anticipation is that GDP growth in 2025 is going to be between 1.5 and 2.4%. That's what the year over year is. So there's a consensus that there will be some growth in the economy in 2025 if we were to generalize that. So when we look at the consensus for when we transition that and look at what is viewed for unemployment, um, the chart that I had there said unemployment is around 4.1% currently. It looks like that the belief is that that will remain in that 3.7 to 4.2 range primarily. There's some folks that have shifted to 4.3 to 4.8, but um, it seems like the consensus is going to remain relatively steady where it is today. And so the last piece of the puzzle in terms of economic outlook, we look at inflation. And so there's a current and a previous here. So there's what everyone says today and what they were previously saying. So not much has changed there. There have been some movements from what was previously believed versus what is currently believed, but it's still anticipated that it's going to be between the 2 to 2.4% range in terms of the inflation. And that's on core PCE. And so that's personal consumption expenditures. That's what that acronym stands for, in case anyone was wondering. But I think it is important to understand that these are forecasts. This is what people think. So much like the forecasts on the price of the S&P 500 index as a whole, for example, this is something that people are anticipating. Whether it actually happens will be heavily driven by a lot of different factors, but primarily, what any potential economic headwinds or tailwinds that happen in the latter part of this year. So projected earnings growth. So this is by sector. Um, this is just looking at what's happening today. Projected earnings growth by companies in each sector and what was, the case on March 31st. What we could see is that information technology, not much of a surprise. There's been a good amount of growth in earnings there, and the projected earnings are the largest on this list. Healthcare is a close second. Also, not a surprise. Healthcare costs have generally increased at a greater rate than inflation historically. And so seeing projected earnings grow in a significant way, not surprising. We also have an aging population. And so a lot of factors at play there, pretty heavy contingent moving into retirement here over the next decade as well. And so that ultimately will continue to drive not only healthcare costs, but also projected earnings growth for companies in that sector. And then you could see down the list there, all of the others. Right there in the middle is the S&P 500, which is kind of right smack dab in the middle of all of these. Collectively, companies in the index are looking to grow earnings at about 14.2% on a 2025 projected basis. So the lowest of which on the list is real estate. Um, Obviously, that's one that's been particularly challenging. Cost of capital is up. There's a lot of other factors at play there, but generally speaking, the projected earnings growth across all sectors looks to be positive for 2025. Um, and so the big drivers with that will be not only growth of earnings, increased profitability, but also what's the cost of capital. So transitioning that into a yield curve summary. So um, there's a lot here. I'll just kind of summarize it pretty simply. What's happening and what we're seeing, where we're at today, is all on the far right part of this chart. And so, as you could see, the shorter duration fixed income periods, so 1 month Treasury rate, is actually the second highest, almost highest interest payment. And so that often gets referred to as an inverted yield curve, if you've ever heard that term. That usually is an indication of some headwinds, some potential recessionary environment on the horizon. We've been in a pretty sustained inverted yield curve for a decent amount of time at this point. Those predictions have not come to fruition as of yet, but this is something that does become particularly challenging when we talk about what's happened in the investment world too. So, for example, I talked about the performance of bonds, longer term bonds. So, buying a 30-year bond right now or treasury is paying about 4.5%, while buying a 3 month bond is paying 5.48. And so when you look at this, there are decisions to be made in terms of like how people participate in fixed income and how they invest in the market. There's also a heavy driver on certain types of debt as well that are directly linked to some of these floating treasury rates in terms of financing, the Federal Reserve overnight rate, how banks lend to each other, ultimately how much capital is going to cost, or how much you're going to be compensated for lending that capital to someone else. And so when we look at this, shorter durations are paying better. Um, as time goes on and as the Federal Reserve becomes more clear on what's going to happen with short-term interest rates, we expect that this chart will change um, as a result of that, and change periodically as those potential cuts are made. Or if they do nothing, things could potentially remain the same. But we are seeing that longer duration fixed income has gone up in terms of rates. So you could see the increases here, double digits for most of those, but still obviously lagging behind some shorter duration. So what does all this mean? If you invest in fixed income, you're getting more in terms of interest payments for shorter duration investments than you would for longer term. As that yield curve normalizes, meaning longer durations become higher paying and shorter durations become the lower paying, that will ultimately cause a shift in the bond market, and we'll see some changes and changes the way in ways that investment portfolio constructed as well. So, all things to keep an eye out for. The big things happening right now. Federal Reserve meetings. So, um, you could see there that there is, one happening right now. Um, September 17th and 18th, November 6th and 7th, and December 17th and 18th. So these are effectively the opportunities for the Federal Reserve Open Market Committee, or the FOMC for short, for them to get together, answer questions, provide additional clarity for what the rate environment will look like for the rest of the year. So these are dates to keep an eye on. These are dates that will be potentially significant if something changes, or they propose changes in their rate cut schedule for the rest of the year. I couldn't finish this presentation without talking a little bit about politics, because we are in a presidential election year. We are actually going to do a more detailed presentation on this. So I only have a couple slides on this front. I'm happy to answer questions on it. We're going to do a much deeper dive on this, on the data behind all of this at a later date. But I wanted to put this chart up here, really just as a point of perspective, which is, over history, we've seen various presidential administrations have had different experiences in the market, most of which have been relatively positive over the over their tenure. But more importantly, when you look at the long term, obviously, regardless of who was in office, there's been a pretty significant run up in terms of overall market performance. And so we get questions all the time, but what if this Congress or this makeup, or, what if we have a Democratic president and a Republican Congress, or vice versa? What if we have one side versus the other? What does that mean? Well, went back to 1950 and looked at the S&P 500 performance. Um, Interestingly, we as a market, and market being an efficient vehicle and really kind of run by um, supply and demand and sentiment and all those other things involved, it seems that we particularly prefer a divided government. So um, take that for what it's worth. Do whatever you want with that information. But apparently, the market reacts better when Congress is basically at an impasse on certain things. Or put another way, you could look at it um, through a different lens of that it requires some bipartisanship in order to get things done. And so we're going to, like I said, we're going to do a deeper dive on this. We're going to look at what's more of what's under the hood, look at historical precedent, look at what to expect this year. But um, primarily, these are a ton of questions that we get today, and it's hard not to talk about it. But historically speaking, not following the crowd has served most investors better. And I have another quick chart on that here in a second. So that's a great transition into the closing of our presentation today, which is stay focused on the fundamentals. So let's talk about following the herd for a second. So the S&P 500 average annual 3-year returns over rolling 3-year periods from 93 to 2023 was about 10.1%. If you were to follow the herd, meaning that you were buying based on directional flows, meaning people were getting in and out of the market and you followed that trend, which happens a lot. There's a lot of movement on a month-to-month basis in and out of certain types of funds, certain parts of the market. Had you followed that herd, 6.4% is the rate of return for that strategy. Had you bought against the herd, meaning you defied or you were a contrarian, put another way, um, you actually outperformed the market on average over those same rolling 3-year periods. So what's the point? The point here is that there's a lot of noise out there, and we all have smartphones. Mine's buzzed probably 20 times since we've been on this call. Um, it's hard to not look at that, see what's going on, form an opinion, or even react based on the speed of which we get information and the things that you hear and the water cooler conversations and all of that. The reality is that we are historically bad at timing, especially when it comes to market vehicles. And so I always say this because fundamentals are important, but it's the singles and doubles that ultimately, can win games for you if you want to stick with the sports analogy. And the same can be true in the market. Trying to hit home runs or trying to time the market just and these aren't my opinions, statistically speaking, has not worked out for a majority of investors. So um, I think this is very important data. It's very important to understand. And I think not following the crowd, especially going back to my previous slides, because we're in a political cycle right now, there will be very strong opinions one way or another, whether you should invest or not, or what's going to happen in the market. Historically, if we zoom out, look over the long term, getting invested and staying invested is ultimately a better strategy than trying to time the market. Bull and bear market trends really quickly through this. The top line, the yellow bull markets, so times and periods where the market S&P 500 was up as a whole. Down, those darker gray bars are the periods of time where it was down for a period. And so what you could see is a lot more yellow than dark gray. They tend to be longer or more prolonged than the down periods. And so this really gets into the idea of discipline, getting in, staying in, not creating too much activity in portfolios and trying to time or beat the market, based on feelings or other noise that's kind of out there in the market. So these are just basic fundamentals. There's nothing overly exciting about any of this. There's not a secret sauce. It's really just sticking with the fundamentals. And so, in that same vein, investing fads. So we talk about this from time to time. AI, and you could see at various points in time there have been big upswings and big downswings depending on what you're looking at. So we saw that with gold in the late 70s and early 80s. Japan was the next horizon, the rest of Asia, the internet and tech bubble, the housing market bubble, China for a little while, biotech. I remember at that time, particularly, I couldn't tell you how many companies came out with these fancy biotech funds that don't even exist anymore. And then we saw FANG, which, Facebook, Amazon, Apple, Netflix, and Google. That was a big piece. And some of those are still around. So I wouldn't necessarily overgeneralize that as a fad. But the newest push is if a company has AI or they say AI, and that's reflective of the earnings calls, that data we saw on that chart, companies are pushing that idea of we're in AI, we're doing this, we're doing that. Companies that are more heavily focused on it have seen a pretty significant run up in their stock price. That does not always mean that they are going to execute perfectly on those strategies. And so the point is that no one of these strategies has ever been a silver bullet. And so diversification is key. Um, and it sounds simple, but really participation in some of these companies certainly worthwhile endeavor, but putting all your eggs in that basket can be problematic, and you could see over the course of time different things that have gone way up and then come way down, have performed that way. Not saying that's what's going to happen with AI, but just being mindful of the fact that things can fall in and out of favor periodically. And so being prepared for that ultimately through proper diversification is a big element of this conversation. So concluding thoughts, and then we'll wrap it up. Current economic activity, especially in the US, remains strong despite higher interest rates. A lot of it is led by strength of consumers. People are still spending money, maybe not at the same rate that they were post stimulus, but still nonetheless are participating in the economy. There's also a growing confidence that there has been a soft economic landing, that's been achieved. The Federal Reserve will ultimately come out after some of their meetings and kind of give us an indication of where we are with that, where they feel we are with that, and then ultimately what are they going to do in terms of potential rate cuts later in the year. Key risks to monitor: inflation. If rates do come down, watching if inflation starts to heat up again or to speed up in certain areas of the market. Geopolitical risk, given what's going on in the world, conflict in the Middle East, conflict with Russia and Ukraine, and other introductions of potential, geopolitical issues around the world will ultimately be a big point of focus and how things proceed. One, not just what happens in the US, but what happens in the global economy as well. And then signs of rising complacency in the markets. So, um, to really summarize that, it gets to people just kind of putting money in one place or getting too complacent with certain areas. So I mentioned like AI, or the next bullet point talks a little bit about the Magnificent Seven. People get a little too comfortable, start to pump a little extra money into some segment of the market. And not really paying attention to the macro trends and what's actually going on, and just assuming that everything is going to go up. And that is obviously not always the case, as most of us on this call probably know and have experienced. Um, the biggest takeaway, I think, is to remain diversified. Despite the fact that a lot of other companies, when you look at the broader market index, have underperformed the companies like that Magnificent Seven, and the ongoing unease in bond markets, I really do think it's important to not get sucked into a trend and pay closer attention to remaining diversified. Also, inherently, by doing that, there are some asset classes that have been out of favor. They is a chance that in the near term, or even in the next 3 to 5 years, they come back into favor. And so having exposure to that will be important now than trying to get exposure once additional like bumps in performance and other things like that happen down the line. And so a conversation that we have with clients a lot, and a phrase that we use, if we help properly diversify a portfolio, that means we're always going to have to apologize for something. There's always going to be something that underperforms. There's always going to be something that's not up to par with the rest of the market. And that's part of investing. If we could all pick winners all the time, we would all be in very different positions in life. But not every company is going to be a winner every single year. And in fact, that's the opposite of what you want anyway over the long term. So remaining diversified, it's very important. Smart diversification too is another piece of that. And those are all things that can be unpacked, on a case by case basis. But I appreciate all of your time today. I'm going to transition and kick things over to questions. I know I talked about a lot. We went through a lot of stuff there. There's a lot of kind of economic data to cover over the first half of the year. But if you have questions, I know we're kind of up on our hour. Feel free to throw them into the chat box or use the Q&A feature. Um, if not, please feel free to go about your day. I know it's 1 o'clock, so we'll stick around for a few more minutes and see if anyone needs anything from us. But if not, we thank you again, as always, for your participation. And we hope everyone's having a great summer. Enjoy the rest of your summer. And thank you again.